In this episode of the MSA Rental Market Update, we are looking at the Reno rental market for conventional multifamily properties. As you can see in the distance, because it's a little remote out here, I had to scroll out quite a bit, you can see that the Reno metro statistical area is drawn out by CoStar. Now, it has quite the strange metro statistical area covering northwest Nevada, and far west, I might add, and where it is in relation to Sacramento, the San Francisco Bay Area, Los Angeles, Phoenix, Las Vegas. Here is Salt Lake City, Utah, Boise, Idaho, and Portland, Oregon is up here. Now that we know where it is, let's take a look at the filters, and as usual, we are excluding all corporate, all military, all senior, and all vacation, and we are only including market and market affordable so that we are only looking at conventional multifamily properties. When we go to location, you can see that we are in market, metro statistical area, Reno, Nevada. So let's go take a look at the analytics and see what the supply snapshot shows us for all asset classes combined. Here is our supply snapshot for the Reno, Nevada metro statistical area. You can see that there are 975 properties in the market, totaling 44,356 units. 4,077 units are currently under construction, and in the last 12 months, 292 more units were rented than went vacant, where in the previous 12 months, 499 more units were rented than went vacant. So we are seeing a slowdown in absorption. You can see that slowdown in the vacancy rate, where 12 months ago it was at 6%. Today it is at 8.5%. And unlike most markets we've seen, the Reno, Nevada actually is in rent decline year over year. So it was at 1541 and now at 1514. So it is showing a year over year decline. Again, we'll take a look and see what it looks like quarter over quarter. As usual, we are not looking at the capital market. We are only looking at the space market. When we come down and look at our long-term occupancy average, you can see that Reno likes to be right at about 94%, and it is currently around 91.5%. So well below that long-term occupancy average. When we get to the end of this video, I will plot where we believe the Reno, Nevada metro statistical area should be. And if we see some discrepancies between Class A, Class B, and Class C, I'll even plot where each of those asset classes may lie on the market cycle chart. So that said, let's go take a look at the data and see what the data tells us for all three asset classes combined. So here is the rent analytic data for Reno, Nevada with all three asset classes combined. We do not look at asking rent. We don't care what the owners are asking. We only care what they are collecting. In the first quarter of 22, it was 1525, went up to 1545, and then down to 1518, down to 1485, and slightly up to 1491 in the first quarter of 2023. Let's see what the deliveries and absorption tell us and see if demand supply fundamentals are at play here. So we can see in first quarter 115 were delivered and 99 more went vacant. Then another 61 delivered and only 34 absorbed. 696 delivered and another 113 went vacant. So we can see that we are trending downward in the occupancy for this market, and that absorption that we saw on the supply snapshot showed the same thing. So for the last couple of quarters, demand supply principles have been reacting appropriately, because 131 absorbed is well short of the 395 that were delivered, and you still hadn't made up the 113 and 696 delivered before the previous quarter. Then 14 were delivered in the first quarter of 23 and 185 absorbed. So we had an increase in occupancy and we had that slight uptick in rents. And the demand supply data shows that that is supported. So let's go take a look and see what each individual asset class tells us. And we'll start with Class A's story. So here is the Class A rent analytic data for the Reno, Nevada metro statistical area. There are 40 properties in the market, totaling 10,487 units. Looking at effective rent, First quarter, it was 1889, went up to 1904, and then down to 1870, down to 1809, and then up to 1828. We've seen this trend consistently across most markets. So as I scroll over and we look at deliveries and absorption, we can see that in the Class A space, most of the properties delivered in the third quarter, no deliveries in the previous 2 quarters or subsequent 2 quarters. And we can see that we did have some absorption first and second quarter. The absorption did not keep up with the deliveries in the third quarter, and then we had a little absorption between the fourth quarter and the first quarter of 2023. So looking at this, we can say we started at 90.4, went up to 91.4 occupancy, down to 91.3, up to 91.4, stabilized at 91.4. So once again, with Class A properties, it looks like demand-supply fundamental principles are kind of taking hold here. But we'll see if this trend continues. We do believe that January was an anomaly. We've seen in the data that January had a feel-good month. There was a lot of stuff going on in the news that said inflation was captured. The Fed wasn't going to raise any more rates, and as we know yesterday, they raised it another quarter point. And just things were going really well. And then, of course, it went flat in February and down in March. So we'll see where this continues. We do have an uptick that we've seen in every single market we've looked at so far since we've been in the second quarter, where we've had this uptick in the first quarter of 2023. Can that last? I don't believe it can, but we'll let the data tell us. I'm not going to make a guess. I can predict that I don't believe it will based on economic fundamentals that we're seeing, but we'll see what the data says. Anyway, this is the Class A story. It is following demand-supply principles, which is good. So let's go see what the Class B story is telling us. So here is the Class B rent analytic data. There are 185 properties in the market, totaling 12,881 units. Looking at effective rent, we started at $1,560 in the first quarter of 22, went up to $1,591, down to $1,562, down to $1,522, and you can almost call it stabilized, but a slight uptick of $4 to $1,526 in 2023 Q1. So let's see what deliveries and absorption say. So we do have the majority of the deliveries and all the asset classes in the Bs. So we delivered 115 in the first quarter and another 19 went vacant, so not good. Then we had 61 deliver and only 27 absorb. Again, not good. 564 more went vacant and another 97 went vacant. So we're seeing a steady downtrend in occupancy all the way until we get to the first quarter of 2023. So 3 straight quarters, really 4 straight quarters of increased vacancy in the market until we got to Q1 2023 and well below that long-term occupancy average. So we can see that slight uptick that happened in the first quarter was a cautionary uptick, even though you had more units absorbed than were delivered, which says that these rents are probably too high for these tenants. But we'll see as it keeps moving forward. All right, this second quarter data is way too early. We're not even going to look at that. So just ignore that second quarter information. So interesting story with Class B. 4 straight quarters of trending down in occupancy, and then that uptick in the first quarter of 23. Let's see what Class C is telling us. Here is the Class C rent analytic data for the Reno metro statistical area. There are 674 properties in the market, totaling 20,533 units. Looking at effective rent, first quarter of 22, it was at $1,254, up to $1,271, and unlike most markets, we have a downtrend for 2 straight quarters, and then it stabilizes. So down to $1,249, down to $1,240, and then a really tiny uptick of $1 in the first quarter of 2023. So really stabilized, did not go down, go up, or anything from fourth quarter to first quarter. Let's see what absorption tells us, because we should not have deliveries in the Class C market. And as suspected, we've got 7 straight quarters of negative absorption. So what is happening here is the renters are saying we don't like these prices anymore. It's interesting, though. Now, we do know that 94% is that long-term occupancy average, and it's sitting at 94.4. So it's kind of high for Class C properties to have that high of occupancy. But it is not surprising. We saw that little uptick in January, or that it was $1 stabilized, and not a further trending downward of the rents, or a faster further trending downward of rents with these negative absorptions. You haven't had more renters than people leaving the market in a doggone near a year. I mean, we're what, 7 straight quarters of negative downtrends. So it's interesting, but it's because these occupancies are still pretty high. So I don't think we'll see the rents trend too far down in the Class C space here, primarily because we still have high occupancy, even though this appears to be around that long-term occupancy average for this market. So what does this say for the overall market, and where would we place Reno on the market cycle chart? Well, we know we are well below that long-term occupancy average, and we are seeing slowdowns and negative absorption for most of the quarters in all 3 asset classes, but we're not seeing very much downtrend in rents. It's kind of trending pretty slowly. So even though we're 2.5 or 3% below that long-term occupancy average, I would place the overall market right here on oversupply until those rents trend down quicker or further. I don't think we're really going to dip into recession. And if we start to see a continuous uptick in those rents, we may push it through recession fairly quickly. I don't think we're going to see that. I think we'll start to see it slide a little further as we get deeper into our U.S. recession, which, if you're not paying attention, is coming pretty doggone soon, it looks like. So Reno, Nevada, I would place right here on the long-term occupancy average between oversupply and recession, but heading down towards that recession part of the cycle. So that does it for Reno, Nevada. The next video we do, which will probably be next week, because tomorrow I will be producing the multifamily how-to series. So look for Greensboro, North Carolina, early next week. I will talk to you guys then.